Jai Hind friends, in this today's video we are going to talk about 6 shares from the FMCG sectors. So these shares according to me are good shares fundamentally. They are also growing at a healthy rate. If somebody is looking to add FMCG shares in their portfolio, you can definitely consider these companies and also do your research. And if you like the company, you can add them in your portfolio only after once you are convinced. So without wasting much time, let's start with the first company. The first company is VBL, which is Varun Beverages Limited. And this company, you can see this company is associated with PepsiCo. It has a franchise of PepsiCo. It sells PepsiCo related products in India, and now not only in India, in other parts of the world as well, like Sri Lanka, and now they are also trying to expand in African countries. So here you can see the company produces and distributes a wide range of carbonated soft drinks and non-carbonated soft drinks, packaged water sold under the trademark of PepsiCo, out of which the brands you can see Pepsi, 7-Up, Mirinda, Orange, Mountain Dew, Tropicana juices, and many more. Here you can see further more brands of PepsiCo, which is 8-Up, Sting, Kurkure, Aquafina, Lipton, Doritos, Mirinda, Frito-Lays, etc. And this company VBL have their own brand as well, which is Jive, Co, Reboost, Creambell, Aquaclear, and Refresh. And here you can see, as I mentioned earlier, it is across 10 countries like India, Sri Lanka, Nepal, and these three countries contributes 83% of its revenue, and then 3% is contributed by some African countries, which are Morocco, Zambia, Zimbabwe. And here you can see that the license also has been extended. In 2019, PepsiCo extended the bottling appointment and trademark license agreement from October to 2020 till 2039. So there is no risk in this area as well. And if we go down further, we can see that this company is also doing the expansion. You can see there have been various expansion that this company has done. You can go through it in detail. So here you can see this company is also doing capex, and everything is going in the right direction for this company. And capex is done by the company when they are sure that after doing the capex, the production that will be done, that will be consumed, the demand will be there. So this company is expanding, doing expansion, doing capex. It has a license also which is stretched till 2039. It is expanding in different countries also. So this is in short about the company. You can read in more detail in Screener website. Now coming on to how the company is performing. So here you can see in short summary, sales growth has been excellent in year 22, 5-year 26, 3-year 35, 12 trailing 122%. Profit growth also has been exceptional. 10-year 49% CAGR, 5-year 47, 3-year 77, and last 12 trailing 127. And stock price CAGR, you can assume if the sales growth is great, profit growth is great, ultimately the stock price CAGR is going to be great as well. So in 5-year time, you can see it has given a CAGR return of 57%, which is phenomenal. 3 years 74%, 1 year 43%, and return on equity also is very good, about 20%, and last year it has been around 35%. So with this only you can make out there is no problem in company's business. The sales is growing, the profit is growing, and then ultimately the share price is also growing. Now here you can see the chart for VBL. So 1 day return nothing, 5 day again nothing, 1 month 4.56%, 6 month 9%, year to date return 25%, very decent. 1 year return excellent, 41%. 5-year return absolutely fabulous, 872% return this company has given to its shareholder in the period of 5 years. And if you see the maximum chart pattern is also going in the right direction, which is from bottom left to top right. So this is also one of the key indicator that you can see in good fundamental company. You will always see their chart going in this direction. Always stay away from chart which are going in the opposite direction, like this way, from the top left to bottom right. Those are the charts that you need to avoid. Those are the companies that you need to avoid. So right now this company is available at a discount of 8%. I think you can keep this company in your radar if you are not aware about this company, and whenever you get an opportunity of around 15 to 20% discount, you can definitely think about this company. Our second company is Mrs. Bector Food Specialty Limited. So they are in the business of manufacturing biscuits and bakery products, and their major brands is Cremica and English Ovens in breads. See here you can see the business segments, and first one is biscuits. In biscuits they have a Cremica brand in India and Mrs. Bector's Cremica, Adoro, and private label in export markets. So their portfolio consists of these various type of biscuits, and it is also a contract manufacturers for biscuits like Oreo, Choco Bakes for Mondelez. And Mondelez is one of the very big company, and Oreo, you all must have heard about this biscuit name, which is very popular among kids. And in terms of market position, it is top two in the premium and mid-premium business segment in Punjab, Himachal Pradesh, Ladakh, and Jammu and Kashmir. The second segment is branded breads and bakery products. So their brand you can see here, it's English Oven, which consists of various type of breads, brown, white, and all those things, bun, muffin, frozen, processed, semi-processed, dough-based products. And it is the leader in Delhi, NCR, Bangalore, Mumbai in premium category. So these are all the top cities of India, and it is also a leader in B2B space. B2B space is like business to business. So they sell their buns and breads to different restaurants also, like McDonald's, and company is also introducing new products. So in FY quarter 25, company plans to introduce category of product including frozen buns, dessert jars, brownies in the Indian retail business segments. And this company is also exporting. So company is the largest biscuit exporter from India, and its share is 12% out of the total biscuit which are exported from India. It exports to around 70 plus countries, and 50% exports are under their own brand. And here you can see in African markets, they are planning to expand its footprint by FY25. Now here you can see the B2B segment related players to whom they service. It is a sole preferred supplier to some of the leading international QSR restaurants like McDonald's, KFC, multiplex chains like PVR, Cloud Kitchen such as Rebel Foods Limited for burger, buns, muffin, garlic bread, and other related product. So company is not only selling directly to the customers, it is also selling to the businesses, the restaurants. And here you can see company is also doing expansion, and which you can go in detail, otherwise the video will be very long. And they're also doing regular capex. You can see here, you can go through this as well. Now coming on to its market share, the market share of the company is still very small. It is not a very big company, it is just 11,000 crores. So here you can see their sales growth, compounding sales growth, which is 5 year 16, 3 year 23, 12 trailing month 18%, and profit growth has been very good, 5 year 33%, 3 year 25, and 12 trailing month 12%. So in the last few quarters, the results have not been very great, but still this company has given a decent result as well. And if you look at the stock price CAGR, 3 year return has been very good, 68% CAGR return. 1 year has also been very good, 49%, and return on equity has been around 15% in 5 year, and last year it was 23%. Now we are at the chart for Mrs. Bector's, and you can see in last 5 years, although it has not completed 5 years, it got listed in December 2020. So in this December, it will be completing 4 years. In the period of 4 years, it has given a return of around 200%, which is very good. So it's a new company only, which we can say, which got listed. It's not very old. It has still not completed 5 years or 10 years. And in terms of market cap also, it is still small company only and growing at a good rate. So this is also one of the company which I like in the FMCG sector. You can also do your own further research. And if you are convinced, you have conviction on the company, you like the company, then you can again do the same thing. Invest only when it is down by around 20% and hold it for long term. Because real money you will only be able to make if you hold a company for long term. The compounding effect of a share that you will only see in long term holding. Our third company is EID Perry. So EID stands for East India Company. So it was a East India Company actually, which you all are aware, which was bought by Perry India, which is nothing but the Murugappa Group. So majorly, this company is into the sugar manufacturing and ethanol production, as you can see. And the reason why I've included this in the FMCG sector is because now this company is spreading its wing in the FMCG sector also by introducing different products. So slowly and gradually, it is moving towards the FMCG sector as well. So this is the company which I believe is kind of ready to take off because it has started now moving towards the FMCG sector. And obviously it belongs to a very renowned group, which is Murugappa Groups, you can see, which is 123-year-old conglomerate. So so in terms of management, we can be rest assured that the management will be excellent. But the only reason that I picked it now is because it has started moving towards FMCG. And here you can see more in detail. So in the new products, you'll see that in Q4 FY24, the company entered the FMCG segment by introducing a premium range of super grains, including millets, dals, and rice. And it is also developing new products like straight grains, value-added items like ready-to-cook health mixes, millet-based idli dosa batters, etc. So this is the only reason that I picked it. And in the focus area also, you'll see that the company focus is to enhance the proportion of non-sugar revenue in its business, insulating it from the commodity sugar realization. So if it would have been only in the sugar area, then I would have not looked into this company, because sugar is a commodity business, and in that you generally don't get, companies which have given you multi-bagger type of return. But the only reason that I'm looking at this company right now is, and trying to get into it before that actually happens and explore into the FMCG sector, which I may be right or I may be wrong, but this is my view. And the reason you can see here, the reason is because this company, although it belongs to a very renowned group and it is now started entering the FMCG sector, it is still very, very small. It is just 15,000 crores. And if you look at its PE, it is just 20.7 PE. And if it is able to grow into the FMCG sector, where you generally get a very, very high PE, around 60 to 80 PE. So this company has a potential to expand or increase its PE from 20 to 60. If it happens, then already you will get a benefit of PE expansion, and you will also get the benefit of the company increasing its profit and sales. And here you can see the company, although it was majorly into the sugar production business, it is still doing okay. 10-year 9%, 5-year 12, 3-year 17, 12 trailing month, its sales is only going down. But this is the bet that I'm taking on company's future. So you can also look into it. Profit compounding also in 12 trailing month, it has gone down, but otherwise if you see 10, 5, 3, it is all great. Stock price CAGR, you will see a different thing, and the reason could be that maybe people are also realizing that it is getting into the FMCG sector, so there can be good growth. So 10-year 15%, 5-year 37, 3-year 27, last 1 year 60%. Return on equity is also decent. So this is basically a okay company if we remove the FMCG part from it. But if we add that FMCG part, then if it starts growing into that area, then it could really be a good company which can give us very, very good return. If it expands its PE, the PE expansion also happens, and it also start increasing its revenue and sales, then we can really, really within a period of 3 to 5 years make a very good return. So it's a company to be on a lookout. You can keep it on your radar, keep monitoring it, what this company is doing, if it is increasing its sales into the FMCG sector or not. But I think it can, because it already belongs to a very good management, which is Murugappa Group, and if they have decided, I think they should be able to execute it as well. But again, this is all my view. I can be wrong as well, so you should always do your own research and then only take any decision. Now in this video, we will only discuss 3 companies, because this video is getting a little bit longer. So the remaining 3 companies we'll discuss in the next video. So thank you for now. We'll meet in the next video. In case you have any questions, you can put your questions in the comment section. In case you want to get your portfolio reviewed by me, you can check the email ID which is there in the description, and you can send me your portfolio. I will try to review it and give you my views on it. So bye for now. We'll see you in the next video.